normal routine as always as part of our lesson. We typically do not have intraday trading days in the afternoon starting at 1:30. So as you all can see, we are in Stock Mastery. It is a trading and analysis day that is presented to you by me and Russ Allen. And we will go from 1:30 to 3:30 Eastern Standard Time, 10:30 to 12:30 Pacific Time. Okay, so with that said, I'm going to stop the application sharing on the XLT schedule, and I'm going to bring up my TradeStation charts. Just want to make sure that everybody is capable of seeing my charts. So go ahead with the green check mark if you are capable of seeing those charts for my benefit. All right, thank you. As is mentioned, it looks like there's not as much participation in the room today, maybe because it is an intraday trading day, not a lesson day, and it is in the afternoon, which is not very typical. But either way, welcome to those of you that are here. With a show of hands, I would like those of you that were in my lesson day yesterday when we were talking about trend in the markets to go ahead and raise your hands so that I can see how many of you are aware of the discussion of what we talked about yesterday. Okay, so it looks like a little less than 20 people were here yesterday for this lesson. For those of you, actually there's a few more with some check marks as well, so it looks like a fairly decent amount of people were there. For those of you that are going to hear this for the first time, you know, just make sure and ask questions, but I'm going to share with you some of the discussion of what we had yesterday. Found an awful lot of people having questions on trend and why they were seeing such frequent stop outs. So as part of my trading and my analysis of my trading today, I'd like to try to bring up here, just want to make sure that everybody's capable of seeing this. I'm going to bring up the matrix. Oh, wrong one. That's okay. And go in here. I thought that I had the matrix underneath there. What I'd like to do is try to bring up either the order bar or the matrix, and so that we can actually, if we are going to be able to see some trading opportunities today, and some of this will actually go ahead and put them in. This is my actual trading account, and I mean this is my actual own charting account, and so I have the capabilities you can see on the bottom of Trading and Simulator. I don't have my trading account through TradeStation, and so I'm going to do this on Simulator. Either way, it doesn't really make a difference. But I do want to do some live demonstrations of actually placing orders. So I'm going to insert my order bar. You all can see that it is linked with the SPY. And then I'm going to just do a little bit of a review. Typically what we'd be doing is at 8:30 in the morning, we would be using that hour before the market opened for our review time and kind of doing our planning. Right now, because we're coming into the middle of the afternoon, I'm going to kind of do a quick assessment of the markets and then look to see if there are any trading opportunities. For the students that are saying that they're wondering how come I don't use TradeStation, I've used the platforms that I've used way back in the day when TradeStation wasn't even in existence as a brokerage firm. It had its charting platform, but it did not have the capabilities of trading through it. And I tend to be a creature of habit, using what I know and trusting what I know instead of going out and learning a whole new platform. So I have used TradeStation with my own accounts, found some things that I didn't like that I liked better in my other platforms, and so I continue to use it. So that's why I did not use TradeStation. Stan Wendy's saying, Erica Ochotnicki disagrees with you about the uptrend on the SPY. Again, I never said that the SPY is in an uptrend. What I said was that shorter term, if the SPY continues to stay with closes above the 117 area, that we are in a very shorter term upward movement to go back to see about the highs that are out there. And so we're going to talk about that as we talk about big picture outlook. So let's switch over now. I think everybody's capable of seeing my charts. I think we talked about that. Here is 4 different charts. These are all of our bigger picture outlooks. This is the SPY on a monthly, the weekly, the daily, and the 60-minute. And again, I'm talking about smaller term current price trend versus bigger picture trend. Right now, when we look at the SPY on a monthly chart, we can see that the movement has been continuing with an upward trend. And what I'm looking at right now on this biggest picture standpoint from a trading perspective is that if this market does not have the capability of closing above the highs of 122.12, and we do close this month below the lows of 117.10, that there's more of a propensity for this market to go further, lower. That's the big picture. It's as extreme as it comes, and I don't know where the market is going to go for sure, but I do know that based on what has happened in the past and with the examples that I'm going to share with you, when we do get closes below the 117 area, that the market will have even further propensity from this monthly chart to have the ability of going lower. All right? Now, why is the close so important? Because of exactly what has happened with these tails. It means nothing to me that prices have gone below here, but once it actually closes below there, if you think back to what the definition of a stochastics is, it tells you that with an uptrend in the stochastics, that in an uptrend, the prices will have a tendency of closing at or near their highs, closing at or near their highs, closing at or near their highs. That's not what happened on this candle. And when we start to see lowering highs and closes below the lows, that's a sign of a reversal or the possibility of a downtrend. So that's why the closes are so important. Now this is only on a monthly picture. And you can see that to the last time on the right of the chart that when we had a lower high and a lower low, prices were not able to close below the previous bar's low, and prices started to go back up. So from a very shorter term perspective, I had to watch to see what was happening as prices revisited this little bitty swing point. And right now, this month, we have come back down into this demand level, and we've tested it, never closed below it, and gone all the way back up. So the most important thing to me right now is, are we going to close back up above these highs of the 121.89 area, or are we going to close below the lows of the 117.24 area? I don't know that. We're only in the 13th of the month, and we still have to go all the way till the 31st of May to be able to know the answer to that. But what I can assure you is that when we go down to the smaller time frames, and we look now at the weekly chart, using that exact same criteria of wrapping your highs, the horizontal lines around the highs of that supply level, wrapping your lower lines around the low that created the high when we were talking about that 122.12, we had 118.25. Now last week when we closed below this low, that was a warning signal of a further downward movement. However, what did we do in that week is we came right back down into a previous demand area that had been holding off of the low levels, and once it closed back up above the extreme high of that candle that produced the low, we have since been going higher. All right, so our weekly and our monthly are still showing us a little bit of indecision and not really positive in exactly what's going to happen, kind of telling us either way. But when you go down to each of the smaller time frame charts from that level, you now say to yourself, okay, from the candle that produced this lowest low, anytime that it starts closing back up above these highs of this 117 area, the market is going to have a further propensity to go back to the upside so long as it never gets back down below these lows. And right now, we continue to stay above the 117 area. Do I know that means it's going to go all the way back up to the 122 area and continue to break out of it? No, but I know that as long as we continue to put in higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, that until we have a day that produces a close lower than the highest high that has been put in, off of the low of that candle, we do not have confirmation of a downward movement yet. So right now I've been saying to you that on the shorter term, smaller basis, there is some strength in this market, okay? We've closed above on the 60-minute bar. We've closed above the high of 113.76 and continued higher. On the daily, we closed above 117 and have continued higher. When we go to the weekly chart, the one thing that we have not been able to do yet is we have not been able to close back up above the weekly high of 120.68. So if this market continues higher, the first thing that it's going to have to do is get above last week's high and definitely up above the high of 122.36. So those are the things that we're waiting for right now. But confirmation is when we get back on the other side of 122.36 to the upside with some buying pressure, we're going to go back up into each of these next higher levels. Now, what about the monthly level? The monthly level is the same as the weekly level. It tells us that 122.12 is absolutely the number. So both on the weekly and on the monthly, if we start closing above 122.12, we have even further propensity of this market to continue to go higher. We're already breaking the 60-minute bar highs of the lowest low. We're already breaking the daily highs of the lowest low. And if we go back into our smaller time frame charts now, okay, I did the 60, I did the daily, I did the weekly, I did the monthly. Now I'm going to go back and I'm going to look at the 30. On the same exact example, using the extreme lows that had been put in, you see that 113.64 was an important level. Once it closed above it, it gapped above it, has never been back down into that area yet on a 30-minute chart. So we're closing above it on a 30-minute. Shorter term time frames are all telling us that there is some strength in this market. And according to the current trend is telling us that on a very shorter term basis right now, we have more of a confirmation of upward movement. I realize this is all consolidation, and I know that we're basing in a sideways pattern and we could easily fall. But we could go rally, base, rally as easily as we could go rally, base, drop. Whichever one happens, all I'm waiting for is the chart to tell me what the trend is. And so far, it's telling me that on a shorter term basis, it's been going in an upward movement. Now we're going to have to back this up a little bit to see what happened on that long candle on a 5-minute chart. But you can see that when you're looking at it on a 5-minute chart, it was that same 113 level. And so across the board, it took on the 5-minute chart a break of 113, which it has closed above it. And when we were looking at it on a 15-minute chart, it was a break above the 113 level. That closed above it. And when we were looking at it on a 30-minute chart, it was 113.64. So on those smaller time frame charts, the closes above the 113.64 level were important. Now as we moved to our bigger picture time frames, we've seen the 60 was actually 113.76 and it closed above it. We've seen that on the daily it was 117 and it's closed above it. The only two charts that are left to tell us that there's confirmation of further upward movement is closes above the 122 level that are out there on the weekly and on the monthly. 122.12 on both the weekly and the monthly. Do you believe that if we start closing above 122.16 that the market may have further propensity to go up? Absolutely. So when you're looking at this, you're just saying to yourself, my 1 minute, my 5 minute, my 15 minute, my 30 minute, my 60, and my daily are all telling me shorter term trend is up. And I do not reverse my thought process of an upward movement until I see a new high that is being put in the current right edge of the market. Okay, we talk about the hard right edge game over and over again, that until the current market produces a new high that does not have the capability of being taken out, and it closes below that bar's low, I'm still in an uptrend. Okay? So as you think about this, that's exactly what I'm saying. I'm still looking for shorter term uptrend. Longer term, I'm going to be looking for what is happening at the end of this month. Okay, can you hear me with the green check mark? All right, so again, when I look at this monthly chart, this concerns me from a standpoint of believing that the market is absolutely in an uptrend. It concerns me with having a bias that the market's in an uptrend from a standpoint that I will not have confirmation of an uptrend until I know that the 122 level is being taken out. And you can see that level also on the weekly. I will immediately reverse my thought process when I start seeing new highs that are being formed as a swing point high and the lows of that high being taken out. But you're never going to hear me say in a classroom, this market is definitely going down. Or you're never going to hear me say this market is definitely going up. You'll always hear me say this market will continue to go in a downward direction if we close below this low and never close above the high. Or you will hear me say we will continue in this upward trend if we cannot continue to violate below this low and we close above this high. Because that is what the realities of what the market is sharing with us. And you can see time and again that it might get you off guard a little bit when we get into periods of consolidation. But at some point in time, and right here is a perfect example of this, as we were continuing with higher highs and higher lows, higher highs and higher lows. We did have a close below this low, and we continued a little bit lower on the next month. This is a monthly chart. We did have a higher high, but a lower low with closes below that extreme low area. And we continued the next month with a lower high and a lower low. Have we ever, since that time, even though prices have traded above the high of 155.53, have we ever closed above 155.53 cents? No. And so in this time, even though the market was looking like there was some strength, as soon as we started getting back on the other side of this extreme high right here, this was the new high that had been put in place. Once we started closing below this area, what ended up happening with the market? Not only did we fail below this low, we continued to fail below each low and continued all the way back down to the origin of the move from which it started. And so if you were never prepared for this kind of a movement and you were saying, oh, this market's just going to keep going higher, yeah, we had a little bit of a pullback. Maybe you got short in here because you've seen the smaller term downward movement, and then it goes up. Maybe it stops you out, but you are not able to recognize the close below this area, and then you miss out on all this move because you got stopped out. That makes you want to throw up. Okay? And I can tell you that there would be plenty of times I'd get in a trade, I'd get stopped out, and then I'd have fear to get into a trade in the exact same area, which I knew was an area I was interested in getting into previously, but because of the fear of losing money again, I wouldn't take the trade. So now what you have is you have to always move your lines according to the new areas that are forming. This was the new high that was out there. It never did close above this extreme high. And when it closed below the lows again, it further continued to move its way down. Now, no matter what Eric or Sam Evans or Russ Allen or Kevin Green or any of the instructors think, Ryan or Michelle, the market's going to do what the market is going to do. But doesn't it make you feel a lot better about at least having a better feel about when the market turns are coming? Anytime we talk about this in the classroom settings before, we were always talking about pattern recognition. We were always looking for a double top or a lower swing high, or a higher swing low at the bottom, or an inverse head and shoulders or a head and shoulders. Well, am I asking you to wait for some kind of a pattern here to give you the earliest clue that there's a reversal that could be imminent? All right, I'm giving you the most basic understanding that so long as prices continue to close near their highs, we're still in a more of an uptrend. As you continue to get into these trades when closes below these lows, you then have never had the head and shoulders pattern that you were looking for. You didn't even get a lower swing high pattern reversal. You never got a really good low risk entry, and yet you knew when you got in this trade that it was a possibility, and the second time you're scared. Okay, so again, I want to make sure that you understand what I'm talking about. Is it's absolutely imperative that you keep going through this and looking for where the areas are that last produced the extreme highs and lows, and know what happens from those areas. Lee says, Michelle, your logic is flawless and makes perfect sense. The issue that I have is application of the information. If we're not looking for longs on the monthly, since a year ago last March got smoked, can you talk today or in the upcoming classes on how we can apply this very useful information in our trading? I don't know, I guess the only way that I know to answer that question is by the trend. For those of you that want to apply this information to your trading, and how can you apply this? Anytime that the market is going up and you're looking for what is the better trade to be taking, no matter if we're coming into a supply level or not, when the market continues in an uptrend and it does not have the ability of closing below the highs of the previous candles, you have to be saying we should be looking for longs. And maybe you should be looking at previous day's lows. Maybe you should be looking at overnight lows. There's lots of different things that you can look at, but I'm telling you right now that the big thing to be thinking about is the big picture outlook. So many people get caught up and hung up on day trading, and they get spanked. And I'm serious in saying that, because they keep trying to buy every demand level in a downtrend, and they keep trying to sell every supply level in an uptrend. And the reality of it is if you can start to feel confident with your trading, look at what happened right here, for example, when you were looking at this as a demand zone. We would have already highlighted this area in our classroom settings from our, from what we do on a daily basis and on our swing trading classes of getting into trades at this demand zone. Now, how many of you may have entered this trade getting into this demand zone, eventually getting stopped out, and then would say, you know what, I can't buy this anymore because I don't know where I should be getting into the trade anymore. I feel like I just got into a trade only to get stopped out, and now look at it, it went in my way. Anybody that this has ever happened to, or this could have happened to as it was approaching this, go ahead with a green check mark. I know it has happened to me a whole bunch of times, so don't be shy about it. But the reality is that once you adjust this low, and you see that the swing point is starting to come back, you already know that this was a demand area where you were interested in getting into a trade. Now what happens when it closes back up above this extreme high that had previously held the low? And absolutely, once it starts to get back up above the candle that had previously been the low, okay, right here that we were talking about entering into our trade. Now how much more comfortable do you feel about absolutely getting back into that trade, even if it means putting on a little bit more risk, only for it to get back up into some of these extreme levels? Now this is big picture outlook. I'm obviously looking at a monthly. This would be something that you would do in your IRA account. But it doesn't make a difference what the time frame is. Doesn't make a difference which chart it is that you're looking at. What I want you to realize is that you use this information to your knowledge to be in the trades in the direction of the market. So many times as a swing trader, what ends up happening is as a day trader, excuse me, is that you get into trades and at the end of the day you said, here was demand, here was supply, I took supply and I got stopped out. Well, were you in an uptrend? Because typically if you're in an uptrend, you should be looking for buys. And you're going to have to go to your smaller time frames to find that. So hopefully I answered your question, Lee. The answer to that is how this information is beneficial for you as a trader is it keeps you in the direction of the market. And it stops you from executing trades in the wrong side. It keeps you from having frequent stop outs, especially as a day trader. Now, as a position trader, it only builds confidence, because when we're talking about the extreme swing point lows and the extreme swing point highs, and many people said, okay, I want to be a swing trader or a position trader because I know where the extreme levels are at. It keeps you out of all of these other levels in between as a swing trader or as a position trader. Because you know that once you have the first confirmation of closes below the previous candle low, and especially once it starts breaking down each of these swing point lows, you know that there is more of a propensity for the market to get back down to the extreme areas in which it started. And that means going from supply to demand and demand back up to supply. And until you absolutely are wrong in that trade and you've been knocked out of it or stopped out of it or whatever you want to call it, you continue to hold on to it. So that's the real value. Now, what I've shared with you is the monthly chart on the SPY. Okay. Now what I want to talk to you about again is moving this down into some of the smaller time frames. When you go back and you look at this on a weekly chart, okay, that was more of a position trading style. Let's look and see what had happened, the benefit of knowing this information, okay, as a weekly trader, weekly standpoint, looking at being into this trade for a few days to a few weeks. Once the market started to close below the level of 118.16 last week on any day, you could have been looking for the short, and you could have known that the demand level to the bottom would have been your profit objective. So long as it never closed back up above 122.36, you had $4 risk in this trade for a profit objective all the way back down to the low of 105 and 110. I don't know about you, but I'll take $4 risk any day for the capability of making all the way back down another 8 or 10 or 12 more dollars. So when you're looking at this, you don't just look at it from a standpoint of this has nothing to do with looking at where I'm entering the trade. This has everything to do with what is happening with the trend of the market. And I find that so many people get confused with what's happening with trend because they overlook all the detail that's on the chart, and they're just looking for extreme highs and extreme lows. They don't know what are the criteria for the reversals, okay? Now, Dylan says, when you're looking for these swing point lows and the highs, how far back are you looking? The charts can go back for years. Well, when you're looking for these swing point highs and the swing point lows, you're always looking at the hard right edge. This is the swing point high when the market, before this movement had occurred on the weekly chart, this had been the swing point high and the swing point low. Now, when you're getting in that trade, once it closes below it, you see that the close was 118.16. You'd have to go to the daily chart to see which day that it closed below 118.16 and know that your profit objective was back to the demand level as a longer term swing trading kind of a capacity. Now as we go back and we look at this on the daily chart, which day last week did the market have the capabilities of closing below 118.16? And the closing candle on 5/5 was 115.97. Here we closed below those lows, and the next the next day after, we had that huge move. You'd have only had to have been in the trade for 2 days, not even for a few weeks like in many of the other cases where you would have had to hold on to it for much longer time. Now, Maria says, Michelle, it's getting difficult to buy individual stocks long now within my rules. It makes sense we're struggling with the SPY on the monthly, possibly forming a head on the monthly. Well, this is the problem, Maria. Right there, your example of what you're saying is the problem that many traders have. They try to form their opinions into the market based on what they think that the chart is telling them, instead of letting the chart prove to them what is happening. And there's a huge difference between saying, I think, I feel, I believe, I see. When you're looking at the charts, there's only two things that are going to determine trend. And it is where the point is that the turn comes in off of the upper level for the sell to come into control, and where the turning point is for the buy to come into control. Okay? Now, Manel says, I love the logic, but what is the best way to reduce your risk when trend has changed, i.e. the smaller time frame? What do you look for at yourself to take the trade? Again, what we're looking at is the smaller time frames in every one of these examples. Okay, 157.20, 148.42. This is the spread if you were taking this trade off of a monthly chart. You'd have almost $10 of risk in this trade. Now we reduce the chart down to a weekly level, and we look at the exact same area. Now we have 122 to 118. Now we've reduced our risk from almost $10 to $4. So we've already reduced our risk in half by going with the exact same high. We've just reduced our risk more than half. As we move over from the weekly to the monthly, and we look at the weekly high, the daily high, excuse me, and we look at the extreme high to the area where the closing was coming in. Now we reduced it from $4 to $1 on the daily chart. So for those of you that want to know how do you reduce your risk, you've used the smaller time frames. And that's why when I've told you the strength of the doors or the strength of the movements come off of the bigger picture outlooks. If you want to know how to manage this trade, here we have about 50 cents risk in the 60-minute chart. Now we've just gone through a 60, a daily, a weekly, and a monthly. We've gone through 4 charts, and yet we've reduced our risk from $10 to 50 cents. Okay? Now, I get in the trade, and I see the same 122.12 level on every chart. When 122.12 closes below 121.64, I believe there's a shorter-term belief of the market to go further lower. I'm in the trade with 50 cents risk. Now I switch over to my daily chart, and I look at the day that the candle produced the low of 121.21. And when it closes below that, now I can say, I even feel better about this trade, that when it closes below this daily candle, I'm in the right trade even more. And so on and so forth. You do the same thing. Now we got below the 121 level. The next level we have to get below to make me feel better about this trade is below 118. Isn't that the exact same thing that I just got done sharing with you? Isn't that the same exact thing that I just got done sharing with you about what happened above 113, 113.60, 117, and now I said we've got to do that at 122. So T says, Brandon does that. It's not just us with this influence, so what's up with that? Okay, I'm not quite sure. Brandon does what? And then it says, okay, but you don't add the closing candle prices to your risk. Okay? What you're doing is I'm telling you that it depends on the style of trading that you're using. You know, as the swing trader, if you've got to use your daily chart for your closes, then you know that when it closes below that area, you know that that's more of a confirmation of the downward trend. But you can see the entries are coming in early off of the 60. That's why when you all ask me what charts do I use if I'm a swing trader, I tell you I use my 60 and my daily. If I can't find a level, I'll go to my weekly. the same way that I use a 5 and a 60-minute chart for my day trades. Okay, when I switch over to my day charts, if I'm looking at a 5-minute chart and I'm trying to identify a level, once this level of the low had been put in and I start closing back up above 112 or 113, excuse me, I know that I'm not wrong in this trade unless it goes back below the lows of 104.94. Now this is an extreme range. We don't typically have that big of a range, and I may decide to pass on this trade because there's not enough reward in it. But I do the exact same thing. If I see this level on a 5-minute chart and I know that the closes have to come above 113, then I go to my bigger picture day trading chart, which is my 60-minute, and I find what level does it have to get above on a 60 to confirm that prices are going to go higher. And I did the exact same thing. Instead of it being 113 now, it's 113.74. And you can see what happens when it closed above it. So basically what you're doing is you're minimizing your risk using the smallest time frame, and then you keep going up a time frame to see what is the level that has to confirm further continuation, and the same exact low, what is the confirmation above the high that has to confirm further up. This is what's going to help you not only to add into your positions, but also to make you hold on to your trades a lot longer, still knowing that you're never wrong in the trade unless it fails below the low. All right. So with a red X, are there any questions that I can have? I can help answer to make it a little bit more clear on what it is that I'm looking for when I'm gauging where the entries are going to be. When I miss out on an entry and I know that it's already trading above my 60-minute bar high, and it's trading above my daily high, and it's trading above my weekly high, if it's in the middle of the range, I stay back and let it go, because I'm going to end up having way too much risk on this trade. And so for those of you that are trying to day trade, many times when you're day trading this market and you're looking at getting in a trade, you've already missed this trade, and now you're trying to get in this wiggle room area. That's why I talk so much about looking at the extreme highs and the extreme lows, because when you're messing around in the middle here, you're playing with fire. You have no idea, are we going to continue to go back up here, or will we continue to go back down? And so the best thing to do is have the capability of recognizing where the turns are coming in at and trying to gauge your entry as close to that level as possible, even if that means waiting for a pullback into this level or a further move up into this area and trying it up there. That's way better than dabbling down here in the middle and only to get burned by the fire. Okay? So, T says, are you including the closing candles price to be included in your risk? Yes, you are. You are including in your plan whatever it is that you have. If you include your entry is waiting for the close, then that is your risk. If you say anytime price passes the price of 113.76, I'm long. Okay? Those are your two choices. You can, as a trader, put it in your plan, I'm going to enter as soon as it goes above 113.76. But you still do not have confirmation unless it closes above it. Now here, this trade you would have missed, because unless you would have had an order that says I'm just going to take it any price above 113.76. It actually gapped up above that price, and the lowest low was 115.35. I would not want to get filled on an order that was supposed to be at 113.76 and get filled somewhere between 116 and 115. All right? So when you're looking at this, make sure you don't get caught up in those gaps. Are you saying that you personally will not enter a trade until the SPY reaches a 106 or a 122 area? As a longer term, better quality trade, I am looking for those entries because I know that those are the ones that are going to produce the highest capability of giving me the better trades with the least amount of risk and the higher confirmation I'm going to be right in the trade. Okay? Now, T says you're going to have some lofty risk levels with that closing bar. Well, that's why I said to you, you don't have to use the closes. You know, the closes are the confirmation that the trend is intact in that way. I didn't say you had to enter the trade using the closes. I said in your plan you have to define, will I wait for the close for the confirmation to enter the trade, or will I just enter the trade above that high knowing that I may still be wrong if it doesn't close above it? That is considered to be a style of trading that you have to figure out which is going to be good for your plan. Now, all of you know that with intraday trading, you can reduce your risk much lower than using the 60-minute chart. You can go back down into a 5-minute chart or a 15-minute chart, and let's look at what happens. You know, somebody asked me, so are you saying that you want to enter this trade into any of the levels other than the 116 or the 122? Well, if you're waiting for that 115 or 116 area, as your higher probability trades. But look at what happens here. Today we have a candle bar that's put in on the first 5 minutes on the S&P. And you all have heard me talk about this breakout strategy trade, okay? When the market comes in on the first 5 minutes, it goes lower than the first low. Never closes below it. And once it closes back up above the high, goes straight up to the exact high from yesterday, does not have the capability of closing above it, and is now coming back, has come back to retest the lows. Never closed below it, and it continues back and forth in this range all day long between the high of the day and the low of the day. This is really a basing day. And so all you would have had to do was wait for the closing candles above the extreme high. Okay, here's the 5-minute bar, but once this low candle was put in and it closed back up above it, you knew that the market would have more of a propensity to go back up to yesterday's high because we never even came back to yesterday's low, so long as it never closed below there. So as a day trader, you can still utilize this information, but your risk to your reward here was a full 50 cents on both sides. It was 1-to-1. And if you don't want to take a 1-to-1 reward to risk trade, you would have passed on this day. Okay? Now, if you look back at yesterday, the exact same example, first 5 minutes come in, the market never gets below the low of the day, starts closing above the high, not of the day, of the first 5 minutes, closes back above it, and shoots right back up to the previous swing point high that had been put in place, which was the previous day. Once it closed above it, produced a new high, which says we're probably going to even continue a little bit higher. Now today, we've never closed back up above that high yet. So any time that you want to use this to your trading advantage as a, in the very beginning, go back to what happened on 5/11. Same exact thing. Here we were coming into that demand level that I was talking about, okay? And market comes back in, puts in this first 5-minute bar. Here's our double bottom, even more of a confirmation of a belief that the market's going to go higher. Closes above the 5-minute bar. Not only does it fill in this gap, closes higher than this high, closes higher than the next swing point high, and continues to produce all new highs. Okay? So I've included in here, this is showing you from 9:30. Now what we can do is you can go to a 24-hour chart, all right? And for those of you that are wanting to know, okay, well, how do I utilize this in the overnight trading? Can I do the same thing? I've seen some questions come of that. Well, look here. Here we are in our overnight trading. 5-minute bar low comes in. You wrap around a line around that extreme low and you have a high. Sits in here in a basing period for quite some time. And the next morning, actually before the end of the day, at 8 o'clock at night, we've now closed back up above that extreme high of 115.26. We closed at 115.30. You're in the trade, carrying it throughout the overnight, and look at the level that is going to have to be broken, previous day's high. That's exactly where it goes to. From 115.26 goes all the way back up to 117.38. okay, and closes above it and now continues even higher. Now, if you go back even lower than this extreme low that had been put in place, and I'm always looking at the extremes and the hard right edge of the chart, okay, the first time that we were coming in here at the end of the night, we had this gap down, lower highs, lower lows, lower highs, lower lows. And again, if you had wrapped around lines around this area, when it closed up above it, it came back down, closed below it. Now you move your line, you take the stop out, you're saying, oh, well, I was wrong, okay? And you don't have to do this. But again, as you come in, you're looking at those areas that I was mentioning. Here's the next low that was put in, and when we close above it, you even get a retracement, and then all this moving back to the upside. Not only do we close above here, we close above the extreme area, we fill in the gaps, and we go back up above the highs. I'm not telling you that you all have to do this. I'm just sharing with you what is my observations from the market that helps you to feel like you have a lot less risk in your trades and feeling a lot more comfortable with the trend. But you can't only look at a 5-minute chart. You have to look at the entire big picture as well. So now, we've spent about 50 minutes talking about the observations of what we see with the SPY, and we talked about where the levels were off of that 117 area on the daily. We continue to stay above the 117, so I'm not wrong in the uptrend on the bigger picture daily chart yet, but maybe the weekly and the monthly still hasn't given us confirmation. Now, as an intraday trader today, what can we do from now until the close to give us some ideas of some trades that we can take? Well, what is happening with today as we're looking at the SPY? How many of you can see that after we're looking at this 60-minute chart, we put in a new high up at the extreme? We had the high level of 174.75. Since the time that that high was put in, we've closed below it, and we've never been back up above it. We also looked to the low that had been put in for the day before the breakdown occurred. We've seen that the previous low during the day had been 167.50. When we closed below that 167.50 at 167, that tells me that there might be a sign of further weakness. And I won't know that this is going to continue with weakness unless we never fail up above the highs. But we're already in the trade short when it closes below this extreme low off that high candle. And if you do not continue to move lower and you start to see a new high that is breaking from the low that was formed, which is right here, now you say to yourself, okay, well, we're in a consolidation market. We're coming up to the extremes. And again, if there's too much, not enough reward to the risk in this trade, then stay away from it. This is the S&P on the futures market, not just the S&P on the exchange traded fund. All right. Let's see. Making sure I'm getting these questions before I take a break. Michelle, if the bar between the 5 and the 15-minute bar is higher, do you use it for your high? Well, the 5-minute bar and if the 5-minute bar is higher, the 15-minute bar is going to have to be that high because the first 3 5-minute bars are going to make up the first 15-minute bar. So that your 5-minute bar high, even if it produced it in the first 5 minutes, that highest high not being taken out, even in the next 2 candles, should still be the high off that 5 and the 15-minute bar as well. You always use the highest high. Daryl says, do you use the pre-market candles? Do you place the same emphasis on them if the lower low is a pre-market candle? Yes, I do. Why is there so much overnight movement setting up for the next day? Because as the prices continue to move back and forth in the overnight, all they're doing is going from swing point high to swing point low, testing the waters. And it's just like a rung on a ladder or an elevator in a hotel. It goes from one level to the next. If it can't continue its move up, it has no choice but to go back down. And so in the overnight, even though there's not a lot of volume and many misconceptions about the overnight trading, it still is going to react the same way. It's usually going to take a little bit longer time. On the right edge, when the pivot is forming, you don't know that this will be the pivot. Do you compare the future pivot to the previous pivot? Oh, I know that I don't have any positive idea, AGTBS, that this is going to be the absolute low. But every time, okay, let me use this for an example. This morning on the S&P 500, we'll go to look at the futures. Here we go on a 5-minute chart. And this is today, for instance. How many of you keep track of the overnight highs and the overnight lows, whether it's on the futures market or whether it's on the stock market? It doesn't make any difference. But how many of you, with a show of hands, use the overnight session as part of your indication of where supply and demand are? Okay, so let's do this. Let's take a look at what happened last night before the market opened. And this is to prove, to go to that point of what was being asked in the question. Well, you don't know what the swing point high and the swing point low are going to be. When I looked at this morning, and I was looking at where the market had traded, I was looking at the overnight session from the S&P, and I had seen that the lowest low that the market was able to put in was 1165.25 on the futures. And I knew that the previous day's low was 1141. Okay, if I back this up and I show you where the low of the day was yesterday, it had been down here at 1141. So my belief was that this market might penetrate through the lows by a little bit of the overnight, but as long as there wasn't enough momentum to keep pushing prices lower, that there was going to be an awfully big drop from 1165 down to 1141. I was going to watch the first few minutes of the day to see what happened, and then I was going to gauge my decision on entering into a trade based around that 1165 quarter area. So this is what happened. Market opens up, okay, and as we come into where the market went to from 1165 quarter, okay, as we're approaching, I'm going into seeing what's happening. This is the overnight trading. Three o'clock in the morning, 5 o'clock in the morning, here's the low. 540, 1165 quarter. And as we're approaching into the day, as we move into into the 9:30 open, I know that this is the swing point low. That is the lowest low that has been able to be produced since last night's open. And I'm asking myself the question, well, as long as we don't have the capability of going a whole lot lower than that, this might not be a bad buying opportunity because I know the trend is up. So what happens as the market opens? Here we come right back down into this 1165 quarter area. And I'm saying, okay, I'm going to be watching for closes back up above, okay? I'm going to be looking for closes back up above this high of 1166.53 for more of a confirmation that the market is going to go higher. I do get one, okay? And then as the market goes up a little bit higher, it comes back down and stops me out. Okay, I'll take the stop out. Now I'm going to watch and see what happens. And as the next few minutes form, I see this new low of 1162. I'm like, those turkeys, they fooled me by just a sec. And I took the second trade, saying to myself, they did not have the capability of pushing much lower than that low. I'm going to be willing to whack it one more time, and as long as it never goes back below this low. Price moved very quickly back up above this extreme high and closed above it, and I had a profit objective all the way back up into 1174 area because I knew that was the level that the market had come from. All right, it didn't get all the way back up to the 1174 area. In fact, it came right up into this range, and from that time continued all the way back down. But that trade, for those of you that are saying you don't know that that's the pivot low, you're absolutely right. You don't know that this is the pivot low, so you take the trade with minimal risk, you take the stop out, and when a new low is forming, as it's coming into one of your supply or demand levels, I knew I wanted to be a buyer today. And so long as they were not able to get through this low with any kind of big volume, when they started closing back up above it, I was a willing buyer. And that's exactly what they did. Now, I still believe that there's more weakness in this market if we do not have the capability of getting back up above these extreme highs. All right? So for the person that was asking about the pivot highs and the pivot lows, not knowing what's going to happen, you're absolutely right. This thing could very well break down. And believe me, the next time that it fails below 1162, I'm never even going to be anywhere near this. I'm going to be dropping that thing like a hot potato or never even entering the trade, because I know that it's tested into this area. It went below it, came back up and held it, but if it comes crashing through this area again, it's all the way back down to 1141 that we have the ability of going to. All right, GDM is saying at Juno.com says the big picture time frame is up. Don't let other people influence your decisions. Use your own frame of mind. Whatever Eriko Chaniki thinks, whatever Michelle thinks, whatever Juno thinks, try to have something that you're using that is concrete, measurable, and that you're using it consistently, and you're able to utilize that information for yourself. The problem is when we start listening to too many other people, it ends up hurting us in the long run. It's great advice. I've always struggled with where to enter if the trend is underway and the trend is missed. I missed the moves, but this gives us an opportunity to get into a trade using a logical approach. You're welcome. What are the things that you look for to determine if it's going to be a basing or a trending day? I don't use anything to determine what kind of trend it is, John. I just let the market show me. I enter my trades at demand levels and at supply levels, and whether it's going to be a trending day or whether it's going to be a basing day, it does not matter to me. Manal, you're asking about this being a previous retest of a demand area. Not sure which chart you're asking about, if you're talking about this S&P, because I see these questions came in a little bit. But again, this had been a low that was holding. And again, the bigger picture tells me that the daily low was 1141.50. And when we come back into this area, we broke through that base of that swing point low, and we went lower, and there are other lower levels that are out there, but big picture tells me that if we start to fail below these areas, there's much more of a propensity for it to go lower. This second trade right here, I took the first trade as a sell, stopped out, and I bought right into this area, knowing that as long as it did not have the capability of failing below these lows with any big volume, I was going to have more of a belief that it would continue to go higher. I didn't take it off of this demand. I didn't take it off of this low or this low. I took it with the belief that so long as there was not enough volume to keep pushing prices lower, that this is absolutely a critical area. No matter what the time frame of the chart is, I knew that that was the Globex low, and that the next low that was really in control from a strength of a door prospect was if the Globex low gets taken out or the overnight lows, then the next low to be tested is going to be the previous day's low, and that wasn't till all the way back down at 1141. All right, I'm going to go ahead and take a break here. Been talking for about an hour. Let's use this time to take about a 5-minute break, and then we'll come in and apply this to different times, other markets. We'll use the equities and see if we can find some trading opportunities. I only take a trade twice in one direction, Daryl. How often do you try an entry and fail before you stop trying twice? That's all I take, because I know that the first time it gets there, if I get stopped out, maybe they were just sweeping up the stops. The second time, if I get into a trade and it gets stopped out, I know that I'm in the wrong direction of the market. That's why I said I won't touch this with a 10-foot pull if price starts trading below 62 again, because I know that the trade is down then, and it'll go probably down into retest this 1140 area. All right, good questions. All right, I'll take a 5-minute break here and I'll be back. Let's see. Yeah, Daryl, I know that you asked about the entries and how often I take a stop out with my tolerance. Again, my rule is I never have more than 3 losing trades a day. And I also, after I'm in 2 trades in the same direction and I get stopped out, I automatically know that there's a very high probability that I'm in the wrong direction of the market. And so I never take 3 trades in the same direction. It's just one of my rules that I have in my plan. So, COPLS says, Michelle, I can say that your last two mastery sessions have been the most valuable to me over the past 6 months. I now see how many wrong trades I made due to not having the proper trend identification. Although this process seems straightforward, putting it in motion is still a little more difficult, especially in the markets that are not trending. A good reason not to trade in a sideways market. Goldman Sachs has been in a sideways pattern on the 15-minute for the past few days with no apparent resolution. Thanks for your insight. Absolutely, no problem. That's what I'm here for. I wish, honestly, the things that there's so much knowledge in my head about all the different experiences that I've had. And, you know, some of this stuff is just so automatic to me that I don't even realize how sometimes that I look at things with the market. It's just, I just look at the market and this is what I see and then I do what I do. But as a teacher and as an instructor, trying to tell someone that has never looked at this before, what has really helped me as a trader is actually forming the rules around what I do so that I can tell it to someone else. And really, when I seen all these questions about the trend, I was like, I just don't understand how come people are having such difficulty understanding what I mean about the trend. And how come so many people are seeming to get, you know, stopped out with this overall uptrend. And at that time, you know, for the last few months before we had this little bit of a downward movement, I just didn't understand how people were constantly getting stopped out. And I recognized that if you go back to the conventional thought process, it's pretty easy to have frequent stop outs. Or if you're just looking at only supply levels and only demand levels and not looking at the rest of it. So I felt that it was extremely important that when I see a lot of students having the same questions, I know that a little bit more time needs to be spent on it. So that's why I've spent the time over the last couple of days looking at this. And I wish that someone would have shared their knowledge with me, and I wouldn't have had to have so many hard knocks in my experience. As long as I've been trading, I can tell you that every day I learn something new. Every day I'm always out there willing to share whatever I can with others because I know that that's the only way that I'm going to get better and that they're going to get better as well. All right. Let's go on and talk about some stocks here. Let's go in and look at, I see somebody is posting about Goldman Sachs, and so just for kicks and giggles, I'm going to take a look at it. Actually, I want to look at it on a smaller time frame chart. So here's the 60, the daily, the weekly, and the monthly. Now let's see if we can go look at Goldman Sachs right now. And I'm not going to try to trade this. I just want to see what the question was about, or what the actual chart is looking like right now. I typically don't have a 1-minute chart up just so that you all know. Usually the only time I use a 1-minute or a 2-minute chart is the first 15 minutes of the day, and then I'll switch it all over to a 5 and a 15 and a 30 and a 60. That'll generally be my layout. It only takes a couple seconds to switch it. So right now taking a look at Goldman Sachs. Let's look at what happened as we're looking at where the lows had been put in on 5/7 and looking at where the market was with Goldman Sachs. Here we have 139.29, and our 60-minute chart tells us that the extreme high point that's going to have to be closed above. Oops, sorry. I always ask, and I tell you to give me green check marks, and the day that I get ahead of myself is the day that you all tell me I don't have it up on my chart, so thank you. You should be able to see the charts now with a green check mark. All right, so here we are with Goldman Sachs. And what we see here is the low of 139.29, a high of 144.57. And the next day, after we had this 5-6 low, we don't really have any great closes above it. In fact, we don't have any. And then the very next day, we gap up with closes above it. However, there are students or there are traders that may have entered this trade above 144.57 with a protected stop below 139.29 if their accounts were big enough, again, only if that was part of their plan. What does it look like on the exact same thing if we're going into some of our smaller time frame charts like our 30-minute and our 15-minute chart? Well, on that same exact day, we can reduce our risk in looking at it that every time a new low is being put in and it has a new swing point low, you just watch what's happening, see that low coming in, the next bar goes above the high, and once we start to have closes back up above 143.72, we continue to have higher highs. We never have failed below the lows, and yet we sit here with some lack of conviction for further continuation to the upside, because at the same time that we've gotten above this high, we still have never closed above the last big swing point high that produced a downward movement. And when we do, then we know that each of these next levels are going to have to be continuing to be taken out for a further upward movement. What does it look like on a 15-minute chart? At that same time period, when we were looking at Goldman Sachs on the 30-minute, what's happening on the smaller time frame chart? So as we move back to 5-6, here's that big long candle, okay? And it looks like the risk is much different. Okay? I always use the candle that produces the lowest low. And in every single one of these examples, I used the candle that produced the lowest low. The lowest low on this 15-minute candle was 139.19. When it traded above it, closed above it, I had confirmation that there was more of a propensity for the market to go higher so long as we never closed below the low. And you see that for the last couple of days after, that's exactly what happened. Now, on a 5-minute chart, we're going to have to back this up a little bit more. 5, that was a little fast. Let's see, 5-6. There's 5-5, and there's 5-6. Okay, here's the extreme low that had been put in, and the candle that produced the extreme low, we look to the candles that had the extreme high off of it, and you see that that reduced the risk. With a 5-minute chart, we now have reduced our risk to $2.50 in comparison to having on a 60-minute chart more than a $5 risk. But every single one of these lows are the exact same low. If you look at the extreme low, it says 139.19. If you look at the extreme low, it says 139.19. If you look at the extreme low, it says 139.19. So on all 4 of these time frame charts, the low remains the same. The only thing different is where the close of the candle is off of the high that produced that low. And the first place you're going to see it with the least amount of risk is always in the smallest time frame chart. Okay, so once the market started closing above 141.41 on the 5-minute chart, we started to see strength. And when we never had the ability of closing below it, for those of you that were willing to take the trade, here was the pullback or the retracement into that level. Now you go up a time frame and you say, okay, if we stay in this trade, what does it say off the 15-minute bar that the market has to get above? Well, now it's more than just the 5-minute bar high of 141.41. On the 15-minute bar, it's slightly higher maybe. And actually it's 141.38, so it must be 141.38 on the 5-minute. The horizontal lines sometimes are inaccurate. Yeah, it is. It's 141.38. Okay, so both the 5 and the 15-minute chart told me once we closed above 141.38 that meant that there was more strength in this market. Then when we go to the 30-minute chart, now it changes from 141.38 to being a new high that has to be closed above at 143.78. So if you've entered this trade long off the 5-minute and the 15-minute, and you're seeing the 30-minute bar, once that bar forms, you're saying to yourself, now I'm going to have to get into the trade when I see closes above the 30-minute candle. And what happens? The new 30-minute candle says if I'm in that trade long, I'm still holding on to it with a stop below here, but I now need to get above 130.43.72. And you just continue to follow that process as you move along. At the end of the first hour, you see that now the confirmation of the upward movement for that day is going to have to be closes above 144.57. So even though we closed above 143.80, we have to now get above 144.57. And that day never happens, but it still doesn't stop you out either. And that's just the way that you look at it. All right, Jay Griffin says, can you tell me why your chat messages are only going to me and Michelle? Well, the reason is because up at the top where it says hi, anybody that enters into the room after we have given you all chat permission, if yours doesn't have hi next to it, that means that you need to ask us to give you chat permission. And all Russ or I have to do is go up to the top, click the hi, and then you'll have the ability to chat. Okay? Now, Gillian says, do you care about the level, volume at which the levels are entered? Truly, I don't. Okay? Truly, I don't care. I know that it's going to take volume below those prices to push it even lower, and I know that it's going to take volume above those prices to continue to push it higher. If it's low volume and I've entered into this trade, I just know that so long as it never goes below the lows with any kind of big volume and closing below it, I'm okay in the trade. All right. Regarding the turning point candle, which one do you use, T? I think I've answered that. I'm using, you'll always see that 1 minute, 5 minute, 15 minute, 30 minute, 60 minute bars, that every candle will have the ability of producing that turn. And so whichever one of them is the extreme low, that's why I keep emphasizing you've got to find the one that produces the lowest swing point and the highest swing point and gauge your entry as close to those areas as possible. If you miss the 5 minute trade, then you might have to enter it off the 15 minute bar. If you miss the 15 minute entry, you might have to gauge your entry off of the 30. But you still know that on all 3 time frames, you're not wrong unless it fails below 139.19. That is the pivotal point, the one that produces the extreme low. It's just that on the different time frames, they have bigger risk on the higher time frames. Okay, no, I'm not saying that you were late. I just was saying that maybe when I pushed the button to give you all chat permission, I could have done that 3 minutes before class started. You could have entered after it, and I may not have done it after, so you may not have been late. All right. Couldn't you start with the 5 minute strategy at the open and then move to the 15 and the 30? Oh, yeah. In fact, today, if you had done that, and I want to move away from Goldman Sachs because I think that this is an expensive stock and most students aren't going to trade it. But let's go into something that maybe you all would be willing to trade. Let's look at Amazon. And that's really what this was. I spent a lot of time talking about what I'm looking at. I really wanted to put this in there so that you all would know what it is, a way that you could put this into your trading plan. Now let's look at today and what happened. On the first 5 minute bar, if you were looking at Amazon and you were looking, and again, this is why when you're watching what's happening with the market, it's always very important to know where is the market telling you that it's going based on the confirmation of the direction of the move. When I was looking at this morning's trading, I always would be looking at what was yesterday's high and what was yesterday's low. The first 5 minutes of the bar this morning when Amazon came in, what did that tell me before anything else happened? What did this first 5 minute bar tell me that I didn't know before the market opened? Anybody have any ideas? What happened on that first 5 minute bar? Strength, absolutely. We had confirmation of strength. Why? Because now we were closing above yesterday's highs. Does that make sense to everybody? In the first 5 minutes, I knew that there was more strength in this stock than there was weakness, at least initially. And until this could ever, the level that was producing the low could ever get closed below, I was not wrong in my trade. Okay? So once I seen this kind of close, I would have to ask myself the question, now what are you willing to do in this trade? You know now that if you didn't enter above a previous day's high and you were waiting for 5 minutes, you've got the close. Now what are your options if you didn't get into the trade on Amazon? Sorry, I didn't realize that the stock had gotten so expensive. But anyway, it doesn't matter. It's still an example. You can wait to buy a pullback, or because you have the confirmation of the close, you can wrap 2 lines around the high of the 5-minute bar and the low of the 5-minute bar, and you can enter into this trade in any price level on a pullback, or you can enter into it above the high. Either one of them is acceptable. The second one is going to have a little bit more risk. Either way, in any of these 3 examples, buying above previous day's high, buying above the 5-minute bar high, or waiting for the pullback, you still know that the low of the day is where you are wrong. Okay? Now, this is only looking at it on a 5-minute chart. Okay? Somebody's saying, yeah, but we're near a big picture supply level. Okay, I'm only looking at this on a 5-minute chart. Haven't gone anywhere else yet. What I'm going to tell you is that on a daily chart or a 60-minute chart, okay, does anybody agree with Manel that this is at a big picture supply level on a 60-minute chart? Okay? On a 60-minute chart, I don't think that this is big picture supply level. All right? When I'm looking at the 60-minute chart, I see big picture level of supply all the way up at the extreme high. And when I'm looking at this today, I say to myself, well, if I look at the lows that were put in and the extreme lows on 5-6, and I look at the highs that were being put in, any closes above 131, 132, excuse me, 131.95 or 132, tell me that there's more strength in this market. What happened yesterday is we got above 132. Now, if I missed that trade yesterday, I have 2 choices. I can just wait for a pullback to the 132 level, or I can take any trade as the market is starting to open and coming back into the first 5 minutes. Now, which of the 2 of those choices are better from a risk management standpoint? Well, the risk management standpoint says the better thing to do is just to wait for the pullback. All right? Now, what I'm seeing here is that after the 5-minute bar is being put in, okay, on that first 5-minute bar, I would have to ask myself, is there any new swing point high that's being put in? The next 5-minute bar produces a higher high. And as long as it doesn't have the capability of closing below the extreme low that is out there of 134.69, my belief is that there's bigger picture, even further upward movement on this 5-minute chart. Keeps going up, and as it continues to form a new high, I move my line up. And I move my lower line up underneath of the candle low that produced that area low. Now, if I'm long in the trade, anytime that it closes below 135.69, I'm out of the trade. Why? Because now I see that on this 5-minute chart, as I go back in time and I look at where we've been, if we do not have the capability of getting back up above 135.69, there is a gap here that had produced a high up at 135.81 that has never been able to get taken out. And if I start to close below that level, that signals that we could go back down to the low of the day that was put in this morning, okay? And if that level gets closed below, there's even further propensity for the market to go back down to the previous day's lows, and that's exactly what is happening right now. Okay, so Amazon showed initial strength, and then if you had gotten long and you just continued to move your levels up above each of the swing point highs with the low that was in control off of that high candle, once it closes below there, you know that you're wrong and you're looking for either one, a reversal, and you're going to possibly go short, or you're just going to sit there and wait for the new levels of demand to give you a better entry. Now, how about looking at research in motion? I know a lot of you have asked about this stock in the past, so let's take a look at it and see what's happening with research in motion. Same thing on our 5-minute chart. We come in, we ask ourselves the question, what is the candle that produced the highest high of the swing point? Well, back on a couple of days, 2 days ago, not today, yesterday, when we go back and look, we had the extreme high of 69.38 on a 5-minute chart. Once it closed below that low, price came back up, retraced into it. Now we have closes below that low of 69.12, and we continue not only to go break the swing point low that had been there, but testing back down, trying an attempt to get back down to the extreme low of the day. Never got there, and then on the overnight session, once we opened back up into today's session and from what happened yesterday, we were never able to get back up above the extreme. Now we ask ourselves the question, okay, we have a new swing point high, don't know if it's going to continue to go higher than this, but let's wrap our lines around the lows that are being formed off of this. If it can't go up to that high, this creates a new high. Our swing point low becomes down here where we have to see some closes. Starts to close below it, retraces back up into it, and not only do we go back down to yesterday's low and continue to close with even further weakness, now we're back into the previous day's low. All right, that's all we've done. If we can't get back up to the highs, we move like the rungs of the ladder, back to the next level, close lower, back to the next level, closing lower. That means we're likely to go back to the next level. Okay? Now, what does it look like on a 15-minute chart? I'll look at AOL as well. All right, here's the 15-minute chart, looking at what happened yesterday. Okay, and again, look at this high. Looks like they faked us out with the belief that it was going to go higher, had a closing candle above this high. Now the next day produces a new high. So what do? Move our lines, and we wrap around our candle, around the candle low that produces the high. Okay, this is a high, this is the same high. The one that produces the low, closing below it. And in this case, if you all are asking me the question, why did you pick that low and not this one, I would tell you this. If it closes below this one and never closes below that one, I would be somewhat concerned. But we get both. We get a close below this one and a close below that one. Both of them had the same high. Once we do, price never comes back to that area and goes right back to the demand of the swing point off of the 15-minute low from the overnight. Now, this morning came back up, was not able to get up into the extreme highs. Once you see this candle producing a swing point high and the new low, once it closes below here, now we're going back to retest the lows from the previous day. Haven't quite gotten there yet, but simply a movement in price from one level to the next, back and forth. Okay? All right, AOL. Somebody's asking if I'll take a look at that one. Here's a 5-minute chart on AOL. Okay, here we were at the end of the day yesterday looking, and this, you can do this first thing in the morning when you enter into the room. You look and see, oh, yesterday we had a high of 24.49. And we also have a high of 24.50, 1 penny higher. We were able to close 1 penny above that high, and then we wrapped lines around the low that had been produced. Once it produced that low, and again, if you wanted to ask me, well, how come you don't go below this one? Well, this is 1 penny higher. But again, what happens? We go below it, we come back up and retest it, and now not only did we take out yesterday's low, we continue down to the next swing point low, okay? And we haven't penetrated through that low, so as price is coming back into this area, which is the area that I told you we'd have to close above each swing point, closing back up above it, now could not penetrate through there, goes back up to test the highs. And it's just a back and forth movement all day long, all week long, all month long. That's exactly what they have. Now you have a new high up here that hasn't been violated. You know that that's not the all-time high of the day, okay? You know that the daily high actually was up here. But before the daily high is ever in control, we have to look at the swing point high that is out there. And so that if you come into this trade seeing closes below it, as long as you never close back up above it, you could start to take some shorts. If you get stopped out of it, okay, well, I know that there's an even better level from the area that was producing the extreme high. Okay? All right. Somebody's asking if I'll take a look at CMI as well. All right, so on a 5-minute chart, and again, remember that if you are looking at swing point highs and swing point lows, first 5-minute bar comes in today, okay? Here is your first 5-minute bar. I'm sorry, that's the second 5-minute bar. Let me remove that. Here was the high that had been put in from the previous day. And we know that when we have closes up above that high, that there's more of a likelihood that as long as volume continues and it doesn't have the ability of breaking down below the lows, that we are okay in this trade. So again, this morning's activity, what ended up happening, gets you into a trade, and then as you're seeing, this becomes a little bit of a little bit more of a difficulty. When you do have trending markets, this can happen. You see a new low that is formed during the day session. That low gets put in at 74.63. Once it closes back up above here, again, still we need that close above the extreme high, comes back, never fails below the low, and once it does close above it, forms a new high. Now you move your high up to the extreme area, and there it is, that once it closed below it, came back up into it, and continued its move down. Where did it go to? Right to the area from the low of the day. I told you, if it can't break out of the highs, we'll have the propensity to go back to the lows, and that's exactly what it's done. Okay? Darden Restaurants, DNDN. Let's take a look at it. Oh no, this isn't Darden. That might be DRDN. So this is Dendrion. Okay, now as we're looking at this on a 5-minute chart as well, you know, I'm looking at where the market produced the turn, the swing point high and the swing point low. As we're looking at the extreme high, what happened on this 5-minute chart when it failed below the low? Never ever gave us the extreme back into the retracement of the extreme high. And as you're looking at this, you're saying to yourself, uh-oh, the next day the market produced a little bit of a lower swing high, and I know that anything that price failure below this lowest closes is a further sign of weakness. What does it do? Go right back down into this next swing point low. As we look at that, we say to ourselves, geez, if this is the next swing point low, what is the area that's going to have to confirm even further upward movement? Closes above 45.72, it does. And still to this minute has never failed below it. And if it does, we know, well, we knew that the next level for the rung up on the ladder was going to be the swing point high. It got back up there, but it just hasn't been able to break out of the extreme high yet, while you still have not been stopped out of it either. Now, if this level does fail, you take the stop out and you ask yourself the question, where's the next trading opportunity? If I am going to be looking for a shorting opportunity, where was the best short? From this morning, we've seen the swing point high up at the extreme high. Once it closed below here, and especially below the same high candle low, because there was a double top here, or tweezer, whatever you want to call it. As we look at these low, the low of 46.62 and the low of 47.05, we see closes below it, pull back up into the area, and a further continuation back down to today's lows. Sometimes there's just not a lot of money-making opportunities out there. And sometimes you'll get into a trade and it won't produce as big of a move as you'd like the first time into it, but the next time it'll have these sharp drops in prices and will continue to have that really big move. This is where you sometimes get into trouble because you get out of the trade and you don't hold on to it for a swing trade or a position trade. You're just doing it for a day trade, and then the day trade ends up getting you out of what was a really good longer-term trade. So on the bottom on Darden, you see that this 43.72 to 42.42 is absolutely that if we started failing below these lows with that weakness, okay, extreme lows, closing below this area, once we start failing below swing point low, failure below swing point low, then we know that the next area, once we get closes below this next one, is going to absolutely be back down into this next area. And yet you've seen closes below these lows with further movement back to the demand areas that were out there. SMH. I think we talked about this one yesterday a little bit while we were in the class. And here's the SMH. This is the exact same thing I'm talking about if you were trading it off of 5 minute, coming in, wrapping around the highs and the lows of the candle that produced that high. As we come in, we see closes below it, retest of that area at the end of the day. If you weren't capable of getting in that trade at the end of the day because you didn't want to hold it in the overnight, you got the gap down this morning and it came back up into that area. And one of the other confirmations that that was a good trade, even if you didn't get short, once you've seen that 5 minute bar low that had been put in this morning, it was closed above, formed a new swing point high, and once it failed below that low again, you knew with that closing prices that it had the ability to go back to this swing point and then the low of the day, which is exactly where it went. So don't ignore these swing points. Look, there was only 2 real areas for profit taking. A lot of people get hung up on each of these other levels. You've just got to know where the turns have the biggest probabilities of coming in. Really, there was only a couple of targets out there. All right, 11 minutes after. Let's go in and take a look at some other stocks and see what we can do about some trading opportunities right now. I'm going to tell you right now that I can count on 2 hands in an entire year how many times I ever trade in the afternoon. And I prefer never to even be trying to put a trade on in the afternoon. This hour of the day is not my time for trading. So if I'm going to share with you any kind of examples of trades, don't be surprised if you watch a stop out, because the reason that I quit trading in the afternoon was I'd make money in the morning and give it back in the afternoon. In case of any of you had that experience happen to you and you're wondering what you should do, you should quit trading in the afternoon. Simple as that. And that's why I've quit trading in the afternoon, because I gave money away in the morning, I'd make it in the morning, and I'd give it back in the afternoon. All right. Somebody's telling me that the S&P is approaching the low. Absolutely. Okay. And somebody's asking me also about Baidu. Can you comment on how a split such as Baidu should be looked at? They changed the prices with the split, and it should be no different. I mean, when there's a 3-to-1 split, the price, if it was at $90, it should go to $30, and the supply and the demand levels don't change. So it shouldn't be looked at anything different. Norman says, so there's not much trading day left in the afternoon trade, pretty much has to be a swing trade. Well, for me, the problem was that I just seen so many levels and so much distraction on my chart that when I came in the morning, my head was fresh, I had a good night's sleep, I looked at the levels, and I just got into the trade. In the afternoon, I said, oh, well, what about this swing point? What about that high? And what about that low? And I just got so distracted that it was easier for me. And also, for years, I sat in front of a computer for 8, 10, 12 hours a day, and I felt like roots were growing into the chair. So I made myself a promise that I was going to work for a half of a day and take the rest of the time off. So it's not because there aren't good opportunities. It's just because I didn't find myself as efficient and on my game as good in the afternoon. Too much distraction. All right. Let's see, what am I looking at here? I just got distracted for a second. Oh, somebody asked me if I'd take a look at the S&P. I think that's what I was going to look at. All right, let's take a look at, do you want me to look at the ES for the S&P futures instead of looking at SPY, or do you guys want to go back to the SPY? Okay, the futures. Okay, at ES. Okay, some people are saying at ES and others are saying SPY. I'll do both. Okay, let's do at ES first. All right, so again, here we are on our 60-minute chart. I'm going to start here first. Okay, when I came in this morning and I told you that I was looking for more of a long scenario, that the market had been going higher, we had continuous days where we had higher highs, higher highs, higher highs. What's going to be more of a confirmation for me of failure for this market is going to be when we start to have lower lows. And the lowest low that's out there from the time that the market turned was 1141. And on that 60-minute chart, you can see the difference between 1141 and 1144.75. So that is the market, that is the candle that produced the last swing point low. There was also one the day before that was at 1140.50, and the high on that candle was 1145.25. So we're real close in that price range, and I'm just going to tell you that somewhere between 44.75 and 45.25, which is only 2 ticks away from each other, that's going to be a likely area that they would have the ability to come back and bounce off of. Why? Well, because the high that was produced today was 1174.75. If you look at what's happening with the market right now, and the reason why I told you I had to get out of my long was because it never had the ability of getting back up above 1174.75. Once it closed below the low of that candle, came back up to retest, it only came up to 73, okay? Then it failed. Now it tested this little bitty swing point low at 65.25, slightly lower at 61.75, and I told you the next time that it goes through that 62 level, I wasn't going to touch it with a 10-foot pole. This is why. Because now that it's failed below 1162, the only area that I believe is the most important area for them to go back to in a bigger picture standpoint is back to this 1141 area. Okay? Now, we're having some weakness, and we do have a lower high, but we still have from yesterday's high a higher high. So long as we never get the low, okay, now look at the daily chart. I'm going to switch this for those of you that are watching here. Let's look at that daily chart. Remember, bigger picture tells me there is not weakness in this market unless, okay, and I don't know what today's low is going to be, but for the time being, we are looking at the lows of 1141 and 1140.5 because that was what the candle had been that produced the highest high and the candle that produced the low off of it. Now, I'm actually going to have to wait and see what the new low is today to know which candle, what the price is off of the low of this candle today to know whether or not that there's going to be downward movement. Because if we close below 1140.50 or 1141, we know that that was the candle that had previously held. And so I'm going to wait for today to see at the end of the day what the new low is going to be. We've put in new lows now towards the end of the day. So what's happening on a 15-minute chart, on a 5-minute chart? We see weakness. All right, we see weakness. Why? Because as I mentioned to you, anything below the level of 1162, 1161.75 was weakness. And I believed that the area that I would have the highest ability to go to was all the way back down to the previous day's low. I don't know that that's what's going to happen today. Might not happen before the end of the day. But I know that so long as we never get back up above the extreme high that had been put in, that is bigger picture, the next level that they'll have the capability of going to, and that's where they're going to prove to me that further continuation below that area with closes is a sign of weakness. Okay. Now, somebody asked me about SPY. Aren't they synonymous? Well, the truth of the matter is SPY is the exchange traded fund of the market, and the ES is the futures market. So they are a derivative. Both of them are derivative of the cash market off of the S&P 500. All right. Not sure why you didn't change, so let's try SPY and then click enter. All right, so what happened today is that while the S&P 500 did go above a previous day's high, the SPY did not. Okay, SPY had a high yesterday of 1162. Oh, I'm sorry, it went 6 cents higher, went to 1168. 117.68, excuse me. Once it got below the low on the high candle that had been formed, with closes below it, came back up and retested it, and now as it's falling below the low of the day, right here, we're seeing closes even lower that are going to likely come back and test first this swing point, maybe this one, and then we have each of the others that are still out there as well. Okay? So what had been a sign of strength just for a couple of days still hasn't been taken out until we closed below yesterday's low. Why? Because yesterday we had a high, and the low off of that high was, from a daily standpoint, was 116.09. Have we failed below 116.09 yet? The lowest low is 116.13. Once we close below that 116.09 low, then we've got to look at the other swing points that are out there. Simply going back and forth between the rungs. Today was more like a lesson day rather than like a live trading day. I tried to share with you my thoughts on trend and looking more at the market, both on an intraday and on a swing trading basis, just to kind of get a better feel of what was happening with the markets. All right, so you were saying that today could still be the high-low of the swing point. Yeah, if you look at a daily chart, here's the SPY, okay? While we have traded above a previous day's high of 117.62, we had a high of 117.68. If we start going below this low of 116.09 with closes below it, now we have the first time that we will have closed above a candle that produced a high and shows us a sign of weakness. So these 2 days, or a couple of days of strength, don't mean much if we start closing below these lows. All right. Now it could just be consolidation or basing. And again, somebody said, well, Eric doesn't agree with you in the shorter term uptrend. Well, again, it's all prefaced with the fact that as soon as it closes below the candle's low of the day from yesterday, that all bets are off to the upside. In fact, this bigger picture downward movement, and we already looked at this on the weekly as well. Okay. Let's go back to our master layout page. We already know that bigger picture chart tells us if the monthly stays below 117.10. Are we below 117.10 on this monthly chart? Yeah. And if we stay below 117.10 with closes, there's more of a propensity for this market to go lower. Have we stayed below 117.10 on the weekly? Not only last week. Okay, the closing price was 111.28, which was well below 117. The high of this week has been 117.68. But believe me, once we start to stay with closes below that 117 area, I'm absolutely with Eric and anybody else who believes that the market has more of a propensity to go down from a bigger picture standpoint. This was only for a very short-term basis, and again, it was all prefaced that we had to continue with higher highs and higher lows and no closes below these extreme low candles. Yeah, and again, if I go to daily and I add on here my 20 exponential moving average, which all of you know that is one of my 5 smoke signals for my reversal pattern. If I throw on here a moving average exponential, and its default is the 20, okay? Have we closed below the 20 exponential moving average? Yeah, on a daily we have. Have we ever closed back up above it yet? No, not yet. And again, we're still staying somewhat below it. So I won't have conviction of this absolute reversal until we start closing above this basing area, which is more than crazy of an amount, and we start to see continuation of higher highs and higher lows all the way back up to 122. You can throw on Bollinger Bands. I know he likes that as well. Okay, insert analysis techniques. Whoops. Insert analysis techniques and go to Bollinger Bands. You can throw the Bollinger Bands on here and use that to your advantage as well. I personally wouldn't leave them on there. But if you do want to use them, change the color. Okay, there you have it. You know, when we came on the outside of this Bollinger Band, penetrated on the inside of it, came back to the 20 exponential moving average, came back out, never went above the extreme with closes above that outside Bollinger Band. And now as we're staying on the other side of the mean, we've gone to the outer edge much lower than the Bollinger Bands and have now started to come back up to the mean. So, you know, like I said, I'm just looking at trends based on what I see from the market, and I know that as long as we stay below this 117 area, we're going to have even further movement. With closing prices below that 117, we'll have more of a propensity for the market to go down. All right. I don't think there's a whole lot more for me to talk about. Hopefully you all found this class somewhat beneficial. And again, I hope that you can have a little bit better of an understanding on the market trend. He's saying, but the lows are still in control. Oh yeah, you're looking at the lows, you're looking at the highs, and you're just working both levels. You just say, okay, well, if the highs can't be taken out, where's the closes below the lows? If the lows can't be taken out on the bottom, where's the high that is going to have the closes above it? And you're just working those two levels back and forth over and over again on any time frame. All right, everybody. I will be back in the morning for the futures class with the lead. I will put on some of the trades in my simulated account and try to share with you examples of actual trades that I'm going to take. You'll hear it on the computer, on my laptop, which is my actual trades, and you'll see it on my simulator as well. All right, everybody, have a great day. Russ, thanks for being here and being my partner in crime for the last couple of days. Have a great day.